Hi, I'm Tom Lydon with ETF Trends here in Hollywood, Florida, at the Inside ETF conference here with Luke Oliver, who's Managing Director of Capital Markets with DWS. Great seeing you, Luke.
Good seeing you, Tom.
A lot of volatility in the marketplace, but where do we stand in the overall market cycle today?
Well, most people are seeing the market structure, the market cycle entering its later phases. So we've seen this real shift in flows away from the growth and momentum stocks, which are a little more pro-cyclical, back towards things like quality. But it's not just quality. You have to be quite careful. As everybody makes that same move, you start to get these other factors come in, like value.
Which also, comes to the fact that ETFs were built on major traditional legacy indexes like the S&P 500, but with more choices like factors today, both advisors and individual investors can be a little more selective, right?
Well, that's right. And at this stage of the market, we're starting to see factors coming into their own, because in a completely upward-looking market, perhaps the factors don't really differentiate themselves. But in a market like this, there are some real value to be added by applying some of those factors, whether it's single factors or multi-factors.
So as you point out, in single factors, you can go out and move your S&P 500, pare it down, buy the factors that happen to be right at the time, or they're multi-factor strategies that within the inherent ETF, they'll actually shift for you. So explain that.
Well, when you use multi-factors, what you're getting is the ability to manage all of those factors at the same time. There's a few different ways of doing that. When you use single factors, you often get a pure play on the factor that you like, but the challenge is that within your overall portfolio, you don't know what effect that one factor being oversized has versus all your other holdings. So it gets quite complicated.
Yeah.
And what we've done with our quality fund is really looked at, we want quality, but we don't want overvalued quality stocks. And so we apply a multi-factor by having two factors, quality and value. But the real hero or the real strategy is quality, but we just add some value tilting to make sure we're not buying overpriced.
So the idea is you don't want to pay too much for that quality.
That's right. You start to unwind some of the benefits of quality if you're paying over the appropriate price for it.
So that's the inherent discipline within the ETF, where everybody would want to go for quality, and quality tends to do well over time, but sometimes they can get a little pricey.
Exactly. When everyone goes in the same direction, stocks can get expensive.
Yeah,
and that's how we
And back to your point, being late cycle, there's a lot of interest in quality stocks.
Yeah, you should be in quality all the time. These are companies with good profitability, low leverage, but in this late cycle, this is where they really start to come into their own.
Okay, what's the ticker symbol again?
QARP, it stands for quality at a reasonable price. So quality without overpaying.
Excellent. Luke, as always, great seeing you. Thanks.
Thanks, Tom.